I'm joined now by S&P Global Ratings Chief Economist Paul Gruenwald, who published a report following the president's announcements about the impact on the global level. Paul, thank you so much for joining.
Great to be here.
Of course, I know you're following the news and the numbers closely,
right.
And we got some new news today. What should our viewers know in terms of assessing these reciprocal tariffs?
Yeah, well, the way we're thinking about this is there was a policy shock. There was a market reaction, which is ongoing, but we're really focused on how much of that translates into the real economy. How much is growth going to slow? How much is unemployment going to rise? What are the credit impacts of that? We're currently in the middle of revising our forecast, but we can say that, the longer this goes on and the deeper it is, obviously the more negative the impact's going to be on the stuff we care about, the real stuff.
What are the latest forecasts that you can share with us based on your models?
Just to give a little tidbit, we're focusing not too much on the U.S. growth this year, but where we end the year. So kind of growth in the fourth quarter.
Yep.
We started the year very strong.
Yeah.
We're now leaning kind of lower than 1% for growth in the fourth quarter for the U.S. Not quite in recession territory yet, but a significant slowdown this year.
That's for the annual GDP rate of 1%.
Right. Mm-hmm. No, the annual is going to be high, but just the fourth quarter over the fourth quarter is going to be less than 1. That number started kind of 2.5, 3, so that's a big drop in the year.
How can you quantify the tariff impact?
Yeah, well, we have to look at certain things, right? So it's going to be, where's the impact of the price going to be? Is it going to be margin squeeze? Is it going to be final consumers? If consumers have inflation, their purchasing power goes down. All the uncertainty is letting people to, pull back on spending, firms to pull back on investment. So what we've actually discovered so far in our modeling, or what we're assuming, is the direct impact of the tariffs is actually less than the impact of the uncertainty. People just don't know what's going to go on. Consumers and investors freeze, and that's going to drive the slowdown if it happens.
So to that end, what more can you share with us about credit markets?
Yeah, well, credit markets, we're starting to see a little bit of stress. We haven't seen, sort of big blowout in spreads. We haven't seen too much stress in the treasury markets, but that's what we're watching, right? Can firms access funds? Is there liquidity in the market? What is the cost of getting new credit? So far, not too much, but that's something the credit guys are focused on very closely.
What is your expectation as to how the Federal Reserve responds in this environment?
Right, well, they're in a tricky spot, right? Because inflation's going up, or at least the price level's going up, and we know activity's slowing. We think they're going to be very cautious until they see the real impacts, which is on unemployment and the pace of activity. They're probably going to go slow. So we think they may only go once this year on the cuts, with a lot of downside risk. If we go into the recession scenario, obviously they're going to accelerate cuts. Yeah. They've got a lot of room. We're still 4.25, but if we're kind of trundling along and inflation's high, they're going to be, I think, cautious, particularly what happened a couple of years ago when the Fed got behind the curve, and they're very conscious of keeping inflation expectations anchored.
Yes, we saw Fed Chair Powell walk back that transitory remark.
Yeah, I think they're going to strike that word from the vocabulary this time around.
Yeah,
correct.
From just a few weeks ago. So it does sound like you do not foresee a recession. Is that the case?
It's not our baseline, but the probability is rising. Our latest numbers are 35% probability over the next 12 months. As I said, we're in the middle of a forecast round. We're probably going to nudge that a bit higher, but we're not quite ready to cross the Rubicon yet and say that the recession is our baseline.
What are the most important data points, Paul, that you are following that will be able to give a clear picture of the scenario?
The number one is the labor market, right? We came out of COVID. We had a big shock in interest rates. We thought the labor market would soften. The U.S. has had this amazing resilience between consumer spending and labor demand. That's really going to be tested this year. If that starts to crack and the labor market goes south, then we're in the recession scenario, then the Fed's cutting rates. So that's the one variable to watch on the real side, right? A lot of stuff's happening on the financial side, but on the real side, it's about U.S. labor market.
And I'm sure that you've looked at history, right? Yeah. Especially when it comes to tariffs and what those have implied. What does history tell us here, and how would you compare these particular levies to what we've seen in the past?
So these are off the chart, right? We're going back not only to Smoot-Hawley, we're above Smoot-Hawley effective tariff rates now in the U.S. We're going back to the McKinley administration. We don't have a lot of data on what happens there. We can say very generally tariffs are lose-lose, but I think, again, all the uncertainty in the market and all of this escalation that we continue to see, that's just putting a lot of downside pressure on the growth. So Traditional models don't have this kind of stuff built in, so we're doing a little bit of fly-by-night.
So make some sense of the bond market for us, right? Because we've seen bond prices come down, yields have risen, even though there are concerns about the growth outlook, the action in the bond market. Is that what we would typically see?
No, right? Usually you'd see a flight to quality and, U.S. Treasuries get bid up and yields down. That's what happened in the global financial crisis. So we're watching very closely what's happened in the last couple of days where that script is flipped. Looks like the euro strengthening, maybe a little bit of movement away from the U.S. as a safe haven. That's material, and we'll be watching how that evolves.
I do see Bitcoin up fractionally here, just about 6 minutes after the open. Gold is higher by nearly 3%. We do see when it comes to U.S. markets that these technology names are catching a little bit of a bid, but the Dow and the S&P 500 down just fractionally. Is there a way, from your purview, Paul, to kind of think about what the impact might be on investors?
Yeah, well, I mean, that's the uncertainty, right? If you're uncertain, you go to liquidity, you go to quality, and you hold off any big decision makings. We're seeing that in some of the M&A. We're seeing that in sort of personal, portfolios. You can see that in the marketplace. But again, the danger is everyone kind of freezes, right? We're going to see how this plays out. These are big moves. We're in uncharted territory. And the risk is everybody freezes, consumers, investors, and then the economy goes into a slowdown.
Can tariffs be effective?
They can be effective if they're targeting a specific misbehavior. Let's say you're subsidizing your exporters and you're shipping them back to me. If I put on a targeted tariff to equalize the playing field and I make that very clear what the objective is, then I think the answer is yes. If tariffs are just kind of, trying to solve 5 different problems at the same time and the numbers don't really correspond to the size of the underlying issue, then they're less effective.
Now, of course, we're waiting to see how long this particular rollout and retaliatory measures that we've seen also by other countries actually plays out. But in terms of the funnel through to the economy, does this have an immediate impact or a longer term impact with a bit of a delay?
Well, unfortunately, those real data sort of come in with a lag. Labor market comes in with a lag. So we're going to have to wait a little longer to see the cracks. But again, the longer this goes on and the bigger rates go, then I think we have a more...
So for consumers watching, how would you be proceeding as a consumer in this environment?
I would be pretty cautious to wait for clarity. I think we're now in a very clear kind of tit for tat game with the U.S. and Chinese. We need to find an exit ramp and a sort of acceptable solution. But in the very, very short term, it looks just like it's escalation. It's like a game of chicken, right?
Speaking to some of the corporate picture, we do see Delta's stock. It's an NYSE listed firm, up about 6% today. Did pause guidance, of course, for the year as it waits for more certainty. That's what we heard from the CEO, Ed Bastian. But that stock at least rising, and what otherwise at the moment is about a flattish market. S&P Global Ratings Chief Economist Paul Gruenwald. Paul, thank you.
My pleasure. Thanks very much.
Good to have you.